Okay, perfect. Now that we're a couple months into the first quarter of 2025, and obviously this has been a very um, a lot of news has come out this quarter, a lot of changes. So what I wanted to do is review the some of the key economic indicators that have come out and just discuss what this means for the overall global economy, and then as well what it means for individual people's portfolios, and just give an idea of kind of how we address a scenario like this. So the question we really want to know, and what a lot of people are asking, is the world heading into recession? Or, as many people are referring to it right now, a Trump session. So, what I want to start with is some forecasts for US GDP in the first quarter of 2025. So, right now, early March, we're a couple months into the quarter. I believe that the actual quarterly data comes out around April 25th. But GDP Now just recently um, provided a major reduction in their economic forecast for Q1. Right now, GDP Now is forecasting negative 2.4% growth for the US economy, GDP wise. But when you look at the trend here, we can see that just back in February, these forecasts for GDP Now were between about 2 to 3%, and at one point we're over 3%. So we've seen a major reduction in the forecast for the U.S. economy, and I think it's important to take a look at this and just discuss kind of what's driving it and how investors should look at this. So first of all, what is GDP Now anyway? So GDP Now is a forecast provided by the Federal Reserve Bank of Atlanta. And what it does is it obviously forecasts the GDP of the US, but it does this in a different way than typical forecasts. So this model provides a now forecast, which means that it incorporates real-time data. And this forecast is always changing. I think it changes every week or two. They essentially update it. Now, if you look at traditional economic forecasts, typically you might get one or two upgrades before or revisions before the actual data comes out. But typically, you're looking at a lot of trailing data or a forecast that is at least a couple weeks or several months old. So what this now forecasting does is it just incorporates more real-time data into the analysis. Now, this is not an official forecast of the Atlanta Fed, but rather they describe it as a running estimate of real GDP growth based on the available economic data for the current measured quarter. So if you want to get more information, you can go to the Atlanta Fed website. Now, the question is, how accurate is GDP Now? So this is somewhat difficult to assess because unlike traditional economic forecasts, this forecast is always changing constantly. So if you're going to test the accuracy of it, you would need to do that at a certain point in time. But there is some information out there. So according to a report issued by the Fed of Atlanta, on average, GDP Now, as expected, becomes more accurate as you get closer to the GDP release date. So in our case, this is going to be April 25th. And right now, we're about 45, 46 days away from that. But when they do their analysis, they figure that 90 days before the release, on average, the absolute error is about 1.1 percentage points. And then right before the actual data is released, that is reduced down to about 0.5 percentage points. So given that we're about 45 days, you would expect on average for us to fall within that 0.5 to 1.1% band there. Now, of course, when they're estimating a decline in GDP of 2.3%, even if they're off by the 1.1%, you're still looking at negative growth compared to what only a month before was expected to be a positive GDP growth quarter for the US. So this is significant. There are other indicators that have come out. There's the Consumer Confidence Index as measured by the Consumer Board Confidence Index. So this fell to 98.3 in February, down from 105.3 in January. So this is the largest monthly decline since August of 2021. And of course, about 70% of the US economy is driven by consumer spending. So consumer confidence is a major factor. Interesting enough, the trade deficit, they widened substantially in January from 98.1 billion to 131.4 billion. Now, of course, with the way that Trump always talks about the trade deficit, this may or may not be an issue when he starts talking about it again. But certainly his intention was not for his rhetoric to increase the trade deficit. Now, a lot of people will say, well, he didn't even take over until later in January, anyways. So, would this have anything to do with the current administration in the US? And I think that that's a very good point to make. However, since the election in November, he's been very vocal. The administration's been very vocal about what they were going to do. And that has certainly driven a lot of business and consumer behavior as well, even before the administration took over. So, one of the reasons, one of the rationales why the trade deficit has expanded so much in January is because a lot of the companies in the US, fearing that tariffs are coming, pre-ordered a lot of their equipment and product, fearing that they would have to deal with tariffs in the future. And of course, the stock market has not performed well this month. The S&P 500 down 5.7% just since the start of March. So not even 2 weeks into the month here. So in terms of economic outlook, we would ask ourselves, so what does all this mean? Why are we seeing lower consumer confidence? Why are we now seeing forecasts lower for GDP? Essentially, what all of this means is that a picture is being painted of strained growth. So the economy in 2024 had a decent year of growth, but it was already showing some signs of slowing. And now we're seeing that continue. We're seeing persistent inflation. People aren't really sure what the Fed is going to do, especially now in the face of other uncertainties. So while employment remains robust and the overall economy in the U.S. continues to remain robust, there are a lot of significant challenges that the U.S. economy faces. And unfortunately, there's been a substantial amount of uncertainty that has been injected into the global economy. And when I say uncertainty, this is the on and off again tariff threats from the Trump administration, and really a fundamental shift in the way that the U.S. deals with its allies. And many U.S. allies coming out and really questioning their future relationship with the U.S. So this creates uncertainty, and business investment doesn't like uncertainty. The markets don't like uncertainty. If you're a company that is considering a major investment, but you don't know if there's going to be tariffs, or if they make an agreement, you don't know if that agreement is going to be followed through. You don't know who your country's allies or enemies are. When that uncertainty is high, people just put off making investments. And when they put off making investments, the economy suffers. So none of this should really be any surprise given what's been going on in the news cycle right now. So what is our strategy in a situation like this? Because I really don't like to talk about economic indicators a lot because it's really difficult to incorporate this into an actual investment strategy. But just on a high level approach, we really think that you need to focus on the things that you can control. And one of those things is staying rational. So it's easy to follow the news cycle. It's easy to invest emotionally, but it's very important to really focus on making rational decisions. Don't make investment decisions when you're feeling emotional. Don't make important decisions after you doom scroll on social media for an hour. Maybe the best time is to just set a certain appointment with yourself first thing in the morning on a certain day where you review what you're doing with your portfolio and make your decisions then. And then for the rest of the day, you don't have to think about it. When you are looking at your current portfolio, certainly reviewing the level of direct tariff exposure that those companies have. Certain industries are going to be more exposed than others, so it's really important to know where you're sitting. We're looking for companies right now in terms of individual recommendations that have good global diversification, as well as flexible supply and customer chains. So they're able to adapt if indeed tariffs come in or there's a major change in the trading relationship, or a significant change further in the trading relationship with the United States and Canada. We're looking for mispriced opportunities in periods of volatility. So we are seeing the market start to react to all of this uncertainty. In some cases, that's justified. In many cases, we think that valuations are too high right now, given the uncertainty that we're seeing. But there are a lot of individual companies that may be relatively unscathed by what's happening, or whereby the risk is not being properly understood by the market, or where they can adapt to the situation. And where we're able to buy these companies at attractive prices, we'll look to do that. We do think that having some U.S. exposure certainly remains wise, just given looking at this from a diversification perspective. Always, we're focusing on profitable businesses that are solving real problems. So when you look at the types of businesses that you invest in, when you're investing in companies that are profitable businesses that are providing services and assets that are essential things that society needs, that are solving important problems, these are the type of companies that are going to be able to adapt to the current environment, and also find ways to grow or come out the other side of the volatility in strong condition. So these are the types of things that we're gonna cover at our live webinar coming up, DIY webinar. It's going to be in April. We highly recommend anybody who is interested in understanding what's happening in the current environment and what decisions you can make or what you can do with your portfolio to help you mitigate that risk, expose yourself to opportunities, and avoid bad investment ideas. We invite you to attend. There will be a lot of these. A lot of the revised numbers will be out by the time this webinar happens. So we'll be able to look at what some of those economic indicators are saying, such as the revised GDP estimate, and then incorporating that into our analysis.
No, that's a good summary of the current economic conditions and what we're doing, and some of the you know from all these crises comes opportunities. We have a monitor list of like 20 companies in the US, 20 in the Canada that we would like to buy. But we've seen high prices for, 18 months at least in a number of companies. And now you see, companies coming. They're not, you're not a kid in a candy store. It's nothing like that. There's certainly uncertainty out there. But, companies are starting to trade at mid, at least, to sometimes in some cases the lower end of their 5-year average price to cash flow or something. So you're starting to see a little bit more historical value than you had certainly end of last year into the start of this year.
So you're saying there's not blood in the streets yet?
No, we're not near that. And people, I know that like we get clients saying, "Oh, this must be an absolute screaming buy right now." Well, you have more uncertainty. Plus, if something was potentially 40% undervalued and it comes down 20%, or overvalued, sorry, and it comes down 20%, it's still not, even if it comes down even more than that, it might come down to which is just fair value. And now you've got higher risk in the market than you had, say, 6 months ago. So you have to factor in current risk. If you're looking long term, there is starting to be some interesting situations. There are some companies that are completely unaffected by tariffs. Like if there's one company in our coverage that makes an iron supplement, and like we've had a hold on the stock in the near term, and if it comes down to a certain range and we tell our clients what the range is, that would be, again, a buy if you're looking 2 to 3+ years out. It hasn't hit that range yet, but it's starting to get close to that range. And that is a time where we would add that company because, again, your iron supplement, if you're iron deficient, you're taking that regardless. So regardless of whether there's a tariff war, you're not going to say, "Oh God, I need to not take my iron because you're iron deficient. You got to take it." So there's certain companies that if they become cheaper because the environment is more risk off, those are the companies that you're going to take advantage of and buy because they're really not affected at all.
And I just want to highlight this is from Linamar's conference call. They had a conference call last week now, and this is just from the executive chair because it really brings out the mindset of these companies dealing with tariffs. So they say we are not contemplating closing facilities in tariff-affected countries and shifting production to the U.S. tariffs as we have seen played out literally in the last 24 hours. Can be implemented one day and removed the next day. They are short-term tactic. We make important decisions such as where to manufacture based on long-term fundamentals like availability of talent and bench strength and supply chain availability and costs in the region, not something short-term as a tariff. So they're long-term view, and that's what you're going to see across these manufacturing companies because it takes years to build out a facility, years to build out a supply chain, and that as much as Trump wants to see, you can't move that overnight. You can't move that in a month, even if there is a month up wait for tariffs, whichever variant he's done. He's already done it twice now, really. Mhm.
No, it generally, like, some of the information, the data that I read, it generally, to build a manufacturing, like a significant manufacturing facility in virtually any industry, when you're starting from the planning phase, the very early phase, is a minimum of 5 years, right? Minimum of 5 years before you could actually see any major shift. Now, I'm sure that there's variation to that depending on the type of facility and size, but I mean, these are multi-year things. And then, these supply chains have evolved over decades, and they evolved the way that they did for a reason. So, even when somebody's sitting here looking at making a 5-year decision to build a factory in the US, why would they? I mean, you would have no idea if tariffs are going to be on or off, over the next year, never mind what's going to happen in 5 years. So I just think that most typically what people do is they delay investment decisions until they feel that they have enough clarity. And when they do that, that means less activity in the economy, and it has a ripple effect. So,
Yeah.
I mean, the economy, I'm not trying to forecast or say anything about GDP now's forecast or whether it's going to be true or not. I can't see a scenario where all this uncertainty is anything but very negative for the economy. But the economy is a very complex organism. I mean, it's very difficult to predict. So there are a lot of different factors that are going to come into play. But uncertainty is definitely a um, major push in the direction of negative economic growth. Certainly.
Yeah, and from interviewing management teams over the past like couple months, the one thing that they're stressing is there's just kind of a freeze up of capital in the near term. People are
Yeah.
just sitting on the sidelines, not making the big investment decision, and that probably extends 3 to 6 months. You probably get some normalcy, maybe you don't, or the new normal becomes you have uncertainty, and then they start at some point they have to make those investment decisions. So
Mhm.
it's probably just smart to delay them right now so you can see that. Aaron had touched on something there too. There was preemptive purchases. Probably you may see that noise in the next quarter from some companies that supply that were over purchased. They stuffed their inventory because of a threat of tariffs, and then you might see a lull. There's going to be some weird, strange items in the numbers of companies over the next couple quarters, I would say. We're also going to get the gauge on just from the CEO or C-suite perspective next week when we sit down with like 25 management teams across multiple sectors. And part of the questions what we'll ask is, how are you feeling about the environment, just generally? And we will get a general broad range of opinions from the C-suite of a number of mid to small to even there's some large cap companies at this event. Yeah, so it's a great event to be able to judge that right straight from the horse's mouth, so to speak.
Highly valuable.
Yeah, for sure.